This is Paul with Tax Lab. We help businesses save tens of thousands of dollars in taxes, and you can too. This is what your accountant, CPA, tax professional forgot to tell you about S Corps. Have you made the S Corp election for your LLC or company? Are you thinking about it? Well, here's one thing that may make you rethink that decision. There are very few downsides to operating your business, your LLC, your corporation as an S Corp. Some of the downsides from an LLC to an S Corp may include increased costs, that of managing, running payroll, and additional tax return. However, one thing that as an S Corp owner you'll want to keep track of is inside basis. Whoa, big term. Inside basis. That's right. Once you are an S Corp, the owners of that S Corp need to take into consideration and track their inside basis. Now, the inside basis, in summary, pretty much is the value that you have been able to add to the company, whether that's through contributions, whether that's through earnings that you haven't extracted from the business, or whether that is loan amounts that that the company owes you, right? So where you're maybe lending money to your company. So these are a few things that go together to make up basis. So what's the importance of this? Well, you cannot, as an S Corp owner, take out or reduce your basis in that company to below zero. It can be zero, but it can't be below zero. You are prevented from taking those losses on your income that would reduce your company's basis or your basis in the company to below zero, so a negative number. Now you might say, oh, well, I don't plan. Well, here's what happens is oftentimes business owners may take distributions out in addition to their payroll. Your payroll, you're probably going to have an easier time kind of keeping an eye on as to whether or not it's totally demolishing your corporate or your company's profitability. But oftentimes your distributions, that little extra you take out here and there, if you do that too often and too much, you could end up reducing your basis. And when you do that, it limits the amount of expenses you can take and pass through to your personal income tax return. This is different from the LLC. The LLC doesn't have owner basis. With the LLC, you have to worry about the hobby loss rule, meaning that in general, if you have more than 3 years of negative, if you have 3 years or more of negative profits in your LLC, then you could be deemed by the IRS to be a hobby, in which case you can no longer claim expenses against the income. You still have to claim the income. That doesn't go away. You always have to claim the income, but that would remove your expenses. So what does that mean? It means that depending on the type of business you're in, if you have very low margins or oftentimes in the negative, it might be better to stay as a LLC. Oftentimes these are companies or organizations with large depreciable assets. That's where this might come into effect more often than not in a healthy company. Is that you might have large depreciable assets, and those depreciable assets may serve to boost in a given year the deductions that you could get as a company. And so it's a good way to manage those ideas and take a look at your business to see if you stand the risk of going negative on basis. The basis is found on your balance sheet. So take a look at that balance sheet. Look at the owner's equity. If that equity number is close to zero or drops below it, you may need to put or reinvest or put some money back into that business, so you don't run into this issue later on. It basically means you took too much money out of your business. That's basically what it means. And so while it might seem like a headache, like a bad rule, what the IRS code is actually doing here, it's actually giving you a little bit of a stick here and saying, hey, it's not good to take all the money out of your business. You need to that business needs to keep on going and supply you and the world with the benefit that it's providing to everybody. And so you don't want to drive your business into the ground. And this is just the IRS saying, hey, more likely than not, you want to be in business to make money. And so you wouldn't be driving your business into the ground unless you're doing something you have some ill-gotten gains that you might be trying to do something with. So they put that rule on there, really prevented a lot of bad things, and it also is not often a problem for businesses that are doing well, but also don't take all the money out. So take a look at that basis, and for if you want a personalized tax strategy for your life, what we're going to do is we're going to take your life, apply sound tax planning principles, and discover the best course of action for you to minimize taxes and increase your wealth generating opportunities. If you're somebody who that might be important to you, go ahead, go to lab.tax, click on advisory services, and book your free client intake interview to see if it's a good match. Wish you guys all the luck. This year's coming to a close, so if you're in business, please get that bookkeeping done. Start on it now if you haven't been brushing up on those books. Brush up on them, get things done before the year's end, so you're not sweating so much when April 15th rolls around. Wish you guys all the best.